Annual equivalent rate or AER and short and gross interest are both terms used to describe the interest earned on financial products like savings accounts, loans, or investments. However, they refer to slightly different concepts and are used in different contexts. Gross interest. Gross interest refers to the interest that is earned on an investment or savings account before any taxes or fees are deducted. It represents the basic interest rate provided by the financial institution without considering any additional factors. This is the interest amount you would receive without considering taxation. Annual equivalent rate. Annual equivalent rate is a more comprehensive measure of interest that considers the compounding effect of interest, making it easier to compare different financial products. It includes both the basic interest rate and the effects of compounding over a specific period, usually a year. Annual equivalent rate assumes that the interest is compounded, meaning that the interest earned in one period is added to the initial investment or balance, and the next period's interest is calculated based on the new, higher balance. It also accounts for any fees or charges associated with the financial product, giving you a more accurate representation of the actual return you can expect. It's especially useful for comparing different accounts with varying compounding frequencies and fees, as it provides a standardized measure for comparing the overall returns. In summary, the main differences between the annual equivalent rate and gross interest are: calculation. Gross interest is the simple interest earned on an investment before taxes or fees. Annual equivalent rate is a more comprehensive measure that considers compounding and any associated fees. Comparison. The annual equivalent rate is particularly useful for comparing different financial products, as it gives a standardized measure of the overall return. Gross interest doesn't provide a clear comparison as it doesn't consider compounding or fees. Realistic returns. The annual equivalent rate provides a more accurate representation of the returns you can expect to receive, as it accounts for the effects of compounding and any associated costs. When comparing different savings accounts or investment options, it's recommended to focus on the annual equivalent rate as it provides a more accurate understanding of the potential returns. Created by Sasanka De Silva for the King's Exploits channel. Thanks for watching.